Curious how to build a UCITS ETF portfolio that mirrors the MSCI ACWI IMI but with less US exposure? Let's find out. Welcome. Every day, I break down personal finance questions asked on Stack Exchange, highlight the community's best answers, and sprinkle in some actionable takeaways. If you're into learning a little more about money each day, make sure to subscribe to the channel. Now let's dig into today's question and see what we learn. Today we're exploring how to build a UCITS ETF portfolio that mimics the MSCI ACWI IMI with less US exposure. Here's the original question as it was posted to Stack Exchange. I'm going to scroll through it quickly so you can see the whole question, but feel free to pause the video if you want more time to read it. Don't worry. After this, I'll walk you through the key points of the question so you get the big picture. So in summary, someone's on a mission to create a portfolio of UCITS ETFs that mirrors the MSCI ACWI IMI index but with less US exposure, around 25% instead of the typical 60%. They wanted to comply with EU regulations, cover about 99% of global equity, and prefer physical replication with a TER of 0.25% or less. Despite digging deep into research, they haven't found a perfect fit. They're wondering if there's a mix of ETFs that could meet their goals, even if it means making some compromises. Here's the top-rated answer from the community on Stack Exchange. I'll scroll through it quickly so you can see the full answer. Feel free to pause the video if you want more time to read it. Don't worry, I'll highlight the key points of this answer in just a few moments. In this answer, someone suggests creating a custom allocation with global ex-US and US total market funds to meet specific constraints. They note that manual rebalancing may be needed if the US fund underperforms and advise comparing costs to optimize expenses. Now, before we jump into the next part, if this video has been helpful so far, be sure to tap the like button and subscribe to the channel. We post new personal finance videos every day to help you make smarter money moves. All right, now that we've seen what the community had to say, here's our take on this question. One smart approach is to mix a global ex-US ETF with a US total market ETF, splitting your investment with 25% in the US and 75% globally. Seek out ETFs targeting developed and emerging markets outside the US to diversify risk. It's wise to choose ones with low total expense ratios and aim for UCITS compliant funds that use physical replication for clarity and ease. So here's what we've learned. To reduce US exposure, combining global ex-US and US total market ETFs works well. Allocating 25% to US and 75% to global ex-US gives balanced exposure. Opt for UCITS compliant ETFs with low TR and physical replication for cost effectiveness. This approach spreads risk across developed and emerging markets. Thanks for watching. Before you go, did you learn something new from this video? If so, be sure to drop a like on the video to let us know.